Good afternoon, everyone. This is Anthony Outllok with Torrey Hills Capital, and welcome to the Millennial Precious Metals webcast for January 24th, 2023. Hope everyone's doing well, and thanks for taking the time to join our virtual lunch today. Many of you are already familiar with Millennial Precious Metals, having been introduced to the company roughly 10 months ago, but a lot has happened in that time, and the management team at Millennial has done an excellent job of de-risking its key assets, and we're happy to have them on today to discuss recent developments and the outlook for 2023 and beyond. Just a quick refresher, Millennial Precious Metals is a Nevada-based exploration company with 7 properties in Nevada and 1 in Arizona. Company has been engaged in an aggressive drill program at its key assets with a PEA expected this year. And we feel that the company is well positioned to become a multi-million ounce producer. The company trades on the OTC market under the ticker MLPMF and on the TSX Venture under the ticker MPM, currently trading with a market cap of only $30 million US. Company has a very strong balance sheet, high percentage of institutional ownership, and as you'll see, is trading at a discount to its peers. So we feel that there's plenty of upside as the company continues to execute its strategy. With us today to discuss Millennial Precious Metals operations and growth strategy going forward is the company's VP of Corporate Development, Jason Banducci. It's great to have you on today, Jason, and thanks for taking the time to bring our viewers up to speed on Millennial Precious Metals. A lot of exciting things have happened with the company, especially in January alone. It looks like 2023 has gotten off to a great start, and I'm happy to have you share those developments with our group. Just before we get started, Jason, I just want to mention, if our viewers have any questions, you all know the routine. Basically type them into the Q&A or chat box, and we'll make sure they get answered. If you can't do that, click the raise your hand icon, and I will unmute your microphone so you can ask directly. So with that said, I'm going to turn it over to Jason Banducci. He's going to take us through the presentation. So Jason, the floor is yours.
Thanks, Anthony, and thanks for everyone that's tuned in. Like as usual, as Anthony said, let's try and make this as interactive as we can. I think most people on the call are pretty familiar with who we are and what we're trying to do here. So I think we can touch on that. But you know, if you want to hear the intro on the company, there's lots of YouTube videos, or feel free to reach out to Jason or myself, and we can walk you through the full story front to back. But I think you know, given we've been very busy on the news front, it's been a busy start to the year. I'd rather focus on new developments, what we see as the key catalyst in 2023, and basically, you know, send it back to you guys. Open forum. Feel free to ask any questions about anything. So with that, I'll kick it off. There we go. So we've got our disclaimer here. I will be making some forward-looking statements, so if you, I encourage you to read the disclaimer on both of our website and on our presentation. So who is Millennial Precious Metals? You know, we're a precious metal exploration development company. We're focused in Nevada, and we're focused on near-surface heap leachable ounces because of their margin and because of their low cost to discovery. If you take a step back and look at, you know, the portfolio and the team behind it, we've got a team who's discovered 59 million ounces of global gold discoveries. And as part of that 59 million ounces, those are real projects. That's across 7 projects, 5 of which are in production or construction today. We have a diversified portfolio of high quality assets in Nevada and Arizona. Today, we're going to focus on Mountain View and Wildcat, which form part of our development portfolio. You know, we've also got Red Canyon, which is located just south of the Cortez complex. That's a Carlin-style deposit, pre-resource, but we think there's a lot of upside there. And we also have a silver copper focused project down in Arizona. So, you know, we've set up the company this way so that we don't need to look at M&A to build the portfolio. We have a portfolio, you know, that's representative of a real mining company. We have assets at various stages of development, and you know, at the front of that at the front of that sort of portfolio is Mountain View and Wildcat, which you can think of as one combined project. They're located about 50, 60 kilometers apart, and we would look to develop them in tandem. And those are the two assets that host the 1.2 million ounces of inferred oxide gold. So if you've been following our news, you've seen that we put out 3 press releases this year, and that answers to this slide. While we believe we're in the business of mineral exploration, what we're really doing is risk mitigation. And for myself with a financial background, this speaks my language. When you're looking at investing in a company similar to Millennial, these are the 4 big question marks. These are the company killers. And if you guys have been around the sector for a long time, you'll know that, especially in Nevada with heap leach projects, if the met doesn't work, it's a zero. It doesn't work. Same with the geotech, same with the resource conversion and the scalability, right? You need a certain size to be able to make these types of projects work, given the CapEx and, inflationary environment we're seeing. But back to, from a news front, we've put out the initial network for Mountain View, which is way better than expected. We see oxide recoveries 85 up to 95%. We're going to support the bottle rolls with column tests that we'll have out. We actually expect the final results from Mountain View in the next week or two, and then we'll go back to Wildcat, talk about the bottle rolls, and follow it up with column tests, and all that work's going to go into the PEA. All the drilling we did last year will show the geotechnical capabilities of the deposit and how steep we can make the pit walls, which is going to impact your mining costs, your strip ratio, everything that affects your margin, which ultimately determines the project economics. All that drilling last year we did at Wildcat and Mountain View. We're going to show resource conversion. You'll see that in the updated mineral resource and PEA that we expect to have out by the middle of the year. And then finally, the scalability. So we actually, this reminds me, I need to do a slide update here. But we have submitted the exploration plan of operations for both Mountain View and Wildcat. You've seen that in our press releases over the last few weeks. And what that allows us to do is do significant step out drilling to grow the resource and, further better understand the geologic models at both Mountain View and Wildcat as we move them towards development. And what this is going to allow us to do is step outside the 5 acres of surface disturbance that we've been limited to. And so the drilling that we did both at Mountain View and Wildcat last year had to stay within that 5 acres. And so once approved by the BLM, the EPO, or the exploration plan of operations, is going to give us a lot more flexibility, 400 acres of disturbance versus 5. So that's when we'll really be able to step out and show the real resource growth. And we've, through the previous drilling programs, surface sampling, mapping, reviewing the historical data, we have drill targets ready for both assets. I'm going to pause there and just stop and see if anyone's got any questions, or if Anthony, if you wanted me to touch on anything else, because I think, the news flow this year, and really that's going to take us through to the PEA, is all going to be focused around these 4 key risks. This is the reason that you see us trade at a discount to some of our peers that have put out PEAs, PFSs that have answered these 4 questions. And by, the middle of this year, we'll have answered these big key risks. And you should see a material re-rating, because you're removing those project and company killer risks.
Yeah, and we don't have any questions in the queue, but I don't know if you want to do it now, but I would like to talk a little bit more about the EPOs that you announced this month. So I'm sure we'll get to that at some point. Or
yeah, why don't we? I can come back to it at the end. And I can get rid of the presentation. We can pull up the press releases, or if anyone has any specific questions, I'd be happy to answer it. But, they're not sexy drill release press releases, but these are real, catalysts for the company that will drive long-term value. And one of the big things that we get a knock on is we spent a lot of cash last year, and yes, we did. But the reality is when you go and apply for these exploration plan of operations, you have to permit a boundary. And what we've done is set that boundary as big as we think we need, not next year, not next program, but for the rest of our exploration that would take us to a production decision. So yes, it was expensive last year. We spent a lot of money doing the baseline work, working with consultants to do all that. But what that allows us to do is not go back and make amendments to it and have to wait on the BLM, right? The permitting process in the US is what it is, but we're only going to have to do this once. And that's why we went above and beyond at both Wildcat and Mountain View to set that boundary as big as we think we're going to need. So we don't have to go back and amend it, and we can drill as much as we want. That'll take us to PFS and production. So I know you guys are familiar with the team. Again, the company is led by Jason Kosick, who's a structural geologist. Also, is able to wear that capital markets hat, which very few geologists can do. Myself, my background's finance and capital markets. I spent the last almost 10 years on the banking side, last 5 in mining investment banking. We've got Raphael Duteau, who's a resource optimization. Basically, he's a resource scientist who worked for IAM Gold for the last 10 years. And then on our board, we've got Ruben Padilla, who's one of the most brilliant geologists you'll see in the space. Terry Harbert, who's the CEO of Talisker Resources. Mike Leskovic, Sarah Heston, and then Eric Tremblay provides that operational expertise, as he was the GM of Canadian Malartic, which you guys are all familiar with. From a corporate profile perspective, you can see we've got 180 million and change outstanding. We're covered by 4 brokers, Cormark, 8, PI, and Stifel. And you can see the ownership breakdown. I think this is what separates us from a lot of our peers. We're over 60% held institutionally. Some of those institutions you can see on the bottom right of the slide here: Merck, Franklin Templeton, Delbrook, Vescor, CI, and Brahma. So we're very lucky to have that kind of support with a company this size. But these are institutions that were in at the inception of the company and that will continue to support us as we move these projects towards a production decision. And I'll just make a quick comment. Obviously, you guys were, so maybe some of you were on the last webinar last week, or you saw the 16 million shares traded. And obviously that was Crescat selling out of their position. We were able to cross the last 4 million. And if you follow the trading, you can see that a lot of I'm just checking the trading today, and we're 150,000 shares. So the trading starting to normalize. You still see a bit of the algorithmic trading. If you guys watch it on CEO.ca, you'll see, CIBC, Canaccord, Anonymous, some small orders on both buy and sell side. And so that's just, it's not anyone selling. It's just algorithms working around the liquidity in the name. And so they basically, they follow where the gold price is going. So if there's a bit of pressure, they'll trade it down. And as soon as gold moves, they'll either trade it up or disappear. So hopefully that provides a bit of color around the trading. But, as I said, we're starting to see it normalize here. And so we've cleaned up that from a trading perspective. And, all of our top institutions are holding strong and very supportive of what we're trying to do.
And can you discuss briefly Waterton as well, and just that whole
Sure.
Yeah, thank you.
Yeah, I'm waiting for the day where no one asks about Waterton. But that's okay. We'll address it. And I think, it also speaks to some of our accomplishments last year. But as part of the go public transaction, when Millennial went public, we bought the assets out of Waterton, and they took 19.9% of the company. Those shares were locked up and released in 4 tranches. We were able to proactively move those blocks of Millennial stock to existing and new investors. We brought in high net worth individuals. That's how we brought in Franklin Templeton. Merck took some of that. Vestor took some of that. So, we worked proactively with Waterton to reduce their ownership position to 0. And along the way, we were able to bring some very strong new shareholders onto the roster.
Thank you for that.
I just saw a couple of questions pop
Yeah,
up.
Can you explain what RSUs are?
So they're restricted share units. So we use RSUs, or the company uses RSUs to pay its employees in lieu of cash. And so it's basically like they pay us, or we get paid by the company in a restricted share that vests over a certain period of time. If you want to read more about it, you can read about it in our MD&A, or any of our financials will outline what the number of those are. And so, as an employee, I may get paid with a certain amount of RSUs that vest over 3 years. And so it incentivizes me to, work hard and to stay with the company. So I see the value of those RSUs go up with the stock price. And the longer I stay with the company, the more of those RSUs I get access to, or that vest.
It's a pretty common way of
Yeah. It's very,
sure.
very common.
I don't know if you want to address this now or later on. Will you need to raise additional capital in the foreseeable future?
Sure. The answer is yes, at some point. That is the business we're in. We're pre-revenue. So the only way you raise capital is either you issue shares or you sell a royalty or a stream on the asset. We'll never sell a stream on the primary asset, on the primary metal. So we wouldn't do a gold or silver stream. There's probably not enough there. We would look at royalty financing. We still have enough cash to get us through at least half of the year this year. So we're not in a position where we need money immediately, but the reality of the existence as a junior exploration company is you always need money, and you're just hoping to do it at higher share prices. That's where it comes in handy to have the likes of Merck, Franklin Templeton, Delbrook, Vescor, CI, Brahma, and a lot of the high net worth individuals that have backed the company. But we do not need money now. We don't need money for another 5-6 months. And at that point, we'll either do an equity raise or sell a royalty. If the market doesn't get any better and we think our shares are undervalued, then we'll go the equity route. The great thing about doing all the technical work to answer those showstoppers, to address those 4 key risks, that's what the royalty providers look at when they look to buy royalties. And so having all that met work done, having the exploration plan, having the geotech work done, that all allows us access to selling a potential royalty on the asset.
Yeah, absolutely.
The assets. I talk about the asset, but I'm referring to both Mountain View and Wildcat.
Yeah, for sure. And I'm sure that the PEA expected early in the year will definitely add to that for sure. As a follow-up, you just mentioned it's asking what is your cash runway, which you just mentioned was like 5 to 6 months. But more importantly, what milestones does that carry you through a potential re-rating, Jason?
Yeah, I mean, back to the 3rd or 4th slide of the presentation, we will answer all those 4 key risks through the resource update and the PEA. And that's all fully funded by the cash currently on hand. And so once you're able to justify and to show the street and show the investment community that you have a project with real economics, and you've done the network, you've done the geotech, you've advanced the permitting, that's what allows you to get a re-rate. So I can confidently say that within our budget, we will get the PEA and resource update done. And we've seen, in the last couple of weeks, we've advanced the projects from a permitting perspective. So we expect to see a re-rate in our stock, and hopefully to see the entire industry re-rate with a bit of a better sentiment towards junior gold equities in the next few months.
Yeah, and I think we're getting there with gold hanging here above 1,900 an ounce. I think it's built a nice base at these levels, and I think it certainly will trade higher. There's the cash. Have you already paid for the EPO for Mountain View?
Yeah, so we've submitted both. So you submit it to the BLM and you work with them. So we've paid for all the long lead items, heavier cost stuff. There's still ongoing costs, but it's not like what we incurred last year. And just to comment on the gold price, you're seeing gold hang in there at over 1,900. And it's Chinese New Year, right?
Yeah.
So and they've been, huge buyers of bullion over the last little while. So I think that shows that the rest of the world cares too.
Yeah.
So I would say it's quite bullish.
Yeah. So here's a really good question. Curious what gold price will be used for base case in the PEA, or how it will be selected with a 200-day moving average, et cetera. Like, what's the way you'll do it?
Like I think, it will depend on what the gold price looks like and what we're comfortable with. And the gold price we use in the PEA is going to be different than the gold prices we use for resource estimation. I think it's funny, right? Because a couple months ago, if you put out a PEA with $1,800 gold, people would laugh, right? Because gold was trending down. It was 1,600. Now, in the last couple weeks, we've seen technical studies go up with close to $1,800 gold assumptions. So I'm not sure exactly what we're going to use. We'll use what's relevant in the context of the market. But when we model internally, we use 1,700 as what we believe, to be the long-term consensus average. And that's, we constantly are asking not that it matters and not that they're right, but we always, follow up with the broker community to get long-term consensus gold prices. And so we'll use both the long-term consensus, which I think is like high 1,600s, 1,700 now, in conjunction with what the market's currently doing around the time that we release the PEA.
Yeah, which I think is fairly
That's
conservative.
kind of what everyone does.
Yeah, which I think is fairly conservative. Just one last question before we move on. How many full-time employees does Millennial have?
Oh, not many. So we right-sized our exploration team, given that we're not drilling right now. So we had to unfortunately let some people go in Nevada. But on the corporate side, I mean, you can see this is it, right? We've got the 4 top executives, plus we have basically someone who handles our legal and corporate affairs named Dave Badham. But outside of that, that's the whole company.
Yeah.
It's been interesting because, we've been approached and we've looked at some potential M&A, both on the corporate and asset level. And so we end up taking a pretty deep dive at other people's companies and assets. And, it's always surprising. It always makes us realize how lean we actually do run this team, because what you see is what you get, right? The board members basically don't get paid.
Mm-hmm.
And you're looking at the entire executive team is on the slide, which is 4 people. Plus we have one more person in the corporate office in Toronto. So it's very, very lean. It makes for a pretty boring office when I come in, but it's a very small, very lean team. There's a couple people that we keep in Nevada, one for permitting, one basically just to help with everything. So whether it's pulling core, if we have investors going down to site, but it's, we do pride ourselves on, it's a very lean team.
Yeah. This management team has done a great job of preserving capital, and they're very, very passionate about the business. And while we're on this slide, Jason, just talk about management's position, because you guys have really put your money where your mouth is. I mean, you and Jason Kay have both taken a substantial position personally in the company, which I think speaks to how much conviction you have.
Yeah, totally. And it's it's a great point. And obviously we don't like to run around telling people how much money we put into the company, but it's an important thing to talk about. And I joined after the company went public, so I didn't get any cheap founders shares, none of that, right? I came in after helping the company go public as a banker, and I bought in all my stock in the market at prices. I think my average cost is double what we're currently trading at, and I put over $165,000 into the company in the market. So unfortunately, it's not worth $165,000 now, but I think it shows you that I've got conviction both on the strategy we're trying to execute and on the valuation. I worked on the other side of the business for a long time, so I know when these things are cheap, and you're never going to time the bottom and you're never going to time the top of the market. But looking at what we have, the jurisdiction we're in, and and the more and more work we do on the assets, the better they're looking. I'm happy to buy in the market. We've been blacked out from buying in the market just with all the PEA work undergoing. You've seen it with all the press releases we've been putting out. We're very busy in the background, but sorry, long-winded answer, but I put over 165,000 into the company. Jason Kosick, the founders, in for over 650,000. Paid for all this stock. He's 35. I'm 33. This is real money for us. And so, we're financially invested and aligned strategically with you guys as retail shareholders.
Yeah. And I just want to make the point that, by bringing that up, that this is a management team that's personally invested in it, and they're invested, you have an opportunity to own the stock at half of what they paid for it. So if they liked it higher than here, I'm sure they love it down here. And personally, I'm also a shareholder as well. I bought a position, small position, but I'll be adding to it in the last month or so. So definitely you're dealing with a management team that is personally vested in this company. So keep that in mind.
And you look at the list of institutions here, they were all in the last financing, which was done at 40 cents, which is almost twice the price that we're seeing today. And they're long-term shareholders. So not only is your average cost at these levels way below management, but it's also way below some of the largest investors in the gold sector.
Absolutely. Thanks.
So you'll all look way smarter than both us and the institutions. Okay, well, let's move on here. I'll quickly touch on the ESG thing. Obviously, it's important, and as millennials, we're trying to do our best to manage both our impact on the society, the environment, and making sure everything we do, both inside and outside the company, is adhering to the highest ESG standards. And part of that is educating both retail investors and youth and people that are looking to get into the industry, that the world we know does not exist without mining. So it's important, and we're making sure everything we do, we're doing it in an environmentally and socially responsible way. So I'm going to flip through the asset slides pretty quick, just so we can leave some time at the end. But as I mentioned, Wildcat and Mountain View form the development stage portion of the company. Wildcat hosts about 775,000 ounces at about 0.4. And yes, it's low grade, but the key is it's low strip. And that's what's going to drive your margin. And that's what allows these ounces to be so economic. And, again, you look at what we're using as our base case gold price is $1,500. So it's a lot lower than what you're seeing in the market right now. We drilled Wildcat last year, 12 holes, 1,250 meters. Basically, this is the first time that we had actually drilled both Wildcat and Mountain View. everything we saw met or exceeded expectations, and basically confirmed that low strip ratio, which is what drives the economics. And you can just see, even from the pictures at site, what you'd essentially be doing in a mining scenario here is you'd be shaving the top off the mountain. When you go there, you walk on site, it's all ore, and that's what's so attractive about this project. And down here you can see the project boundaries and the claims, and you can refer back to the press release we put out on the exploration plan. But we've basically permitted this entire claims block to allow us for future to allow us to complete future exploration drilling under the plan. So you can compare the maps, but we've gone above and beyond and permitted more than we need, so we don't have to go back and amend it. And this was some news we were very excited about last year. Due to the market, we wanted to do as much as we could at a low cost to show exploration growth without having to go in and drill, because again, the markets were very challenging and the drilling in Nevada is very expensive. So we did property-wide surface sampling and mapping. We basically doubled the size of the mineralized footprint. We've got 5 new target areas. So we know we're going to be able to grow this thing. And now we've gone and submitted that exploration plan. So once we have that, we can step out, show real material growth. But in the meantime, we do still have some flexibility to continue to drill under the exploration without the EPO, we can still go in and drill more. Essentially, we still have pads that we constructed for the last round that we can use. So we've got a lot of flexibility to grow the resource. Just moving to Mountain View, again, 50, 60 kilometers away from Wildcat. So we look at them as one asset. It's one mining complex. You bring Wildcat on first and then bring Mountain View online 2 years later. So you can use the cash flow from Wildcat to fund Mountain View. It's a bit of a smaller resource, but again, we see a lot of growth upside here. It's higher grade, a little bit higher strip, but I'll show you on the next slide why it's not a true strip. And what creates that strip is this alluvium here, which is basically a loose sand and gravel. And in a mining scenario, you can just scoop that out. You don't have to drill and blast it. So it's a strip, but it's not going to drive the same sort of stripping costs that you traditionally see in an open pit. Heap leach. Again, we drilled this last year, 27 holes, 7,200 meters, same thing. Everything we wanted to see, we saw, were confirmed historical data. All the grades are at or, exceeding what we had in the old model. We potentially discovered this feeder zone, oxidation profiles, nice and deep. Everything that you want to see for the upcoming PEA was there. And more importantly, we identified several areas for exploration and expansion drilling, which we've actually got highlighted on the press release that went out today. So we'll go back and we're going to drill this hopefully towards the end of this year. And again, so that will be your second leg of growth before we move towards a production scenario. I see some questions. I just want to, if it's a question about Wildcat or Mountain View, we can address it now. Otherwise, we can.
Yeah, I'm going to hold it till the end because
Okay.
it's not specific to that.
Sounds good. Okay, and so last we'll just touch on Red Canyon, and this project excites a lot of people. It's a little earlier stage, but it's in the best postal code per se in Nevada. You're 30 kilometers south of the Cortez complex run by Barrick and Newmont, which is the most productive mining complex in the state. And this was the asset we drilled first when we went public. We drilled about 12 holes, 2,300 meters, and it returned some of the best drill holes you'll see in Nevada. And those drill highlights are right here. And you can see, we always point back to hole number 2, which was 54 meters at 4.54 grams per ton from surface. So that puts that hole in the top 1% of all gold intercepts drilled in 2021. So we know there's something there. It's Carlin style, so it's a little bit more expensive. Well, not a little bit. It's a lot more expensive to drill. And so our plan is to do a little bit more surface mapping, maybe some geophysics, geochem this year, and then depending on market conditions, either go back and drill it later this year or next year. But this is the asset that attracts the Barricks, the Anglos, all the big guys to our company. And so we've got, we've had several conversations with the bigger companies, potentially either around a JV, or we'll look at some sort of structure that allows us to extract value without blowing up the company, raising money to do this type of drilling, because it is very expensive.
Would you ever consider selling that asset? I mean, I know it has shown some really good results so far, but is that something you would definitely want to drill? A lot more?
I think we'd like to do one more round of drilling to just know exactly what we have. I don't know number of ounces exactly, but we know there's a couple 100,000 ounces there. We're fairly certain. Whether it's 5, 10, 20 million, we don't know. We've got to go back and drill it. But, at some point, if maybe it's not, a 10 million ounce deposit, if it's a little bit less and we won't mine it internally, there's lots of other mining companies around that could use that type of, ore feed at that type of grade. So we've got a lot of optionality with it. It's never been in the public markets. The focus is Mountain View and Wildcat, but this provides that blue sky, real optionality in buying the stock.
Yeah, this just came in the chat. Why did you choose Wildcat in Mountain View over Red Canyon in terms of development? Because
we had clear line of sight to them. Again, we stripped down the historic resources. We did a very conservative resource estimate to basically go public, which was 1.2 million ounces. And at 1.2 million ounces of oxide gold in Nevada, like, you can build a mine around that. Red Canyon's earlier stage, there is not enough drilling to publish a resource. And so, we understand what drives value in this business, and that's moving ounces towards permitting, towards a mining permit. And Wildcat and Mountain View allow us to do that quicker and cheaper in the near term.
Great.
Hopefully
Thank you.
that answers the question.
Yep.
We always like to come back to this slide. It's important when you're looking at investing in mining companies to look at the valuation for sure. And that's my background, but it's very important to make sure you're comparing apples to apples when you're looking at assets. And when you're looking at Nevada or any sort of open pit oxide gold projects, grade is important, but the most important thing you need to look at is margin. And what drives margin is your grade and your strip ratio and your recoveries, which, again, once we have those numbers, we're going to add that layer into this chart. But when you compare Mountain View and Wildcat to all the other Nevada oxide gold projects, we actually have the highest adjusted grade, period. And how you get that adjusted grade, that strip adjusted grade, is you divide your resource grade by your strip ratio. Your resource grade is only half the equation. Your strip ratio is going to drive your costs and your margin. And so you have to look at them both together. And again, when you take a step back and look at these projects in Nevada, we have the highest adjusted grade project out there. And you look at some of the peers, and Westfault, Hasbrook is basically owned by private equity. Anything inside a black box has been involved in M&A in the last year. And so, the Nevada M&A market's been very, very busy. You're seeing more and more companies as new entrants into Nevada as they want to diversify away from, places with higher geopolitical risk. And so we think we're really well positioned, twofold. If we can get these projects up and running into production, we're going to see a premium multiple versus projects that are in higher risk areas. And the other side to that is, if someone wants to buy out Millennial once we've got permitted ounces, they're going to have to pay up. And that's, that looks at, the next slide is the average Nevada acquisition cost is $90. We're currently trading at $15, $16, $17. So that's why we focus our energy on Mountain View and Wildcat, because we can get those two assets towards a mining permit the soonest and the cheapest. And that's what's going to allow you to realize $100 an ounce value in the case of M&A. And I'll flip back to the slide. I slipped back over. I thought my brain was working 2 slides ahead. But this slide's equally as important, and it just touches on margin and why that's what we pound the table on, because it's great to have 10 ounces or 10 grams per ton, but is it economic, right? And this shows you that at our strip adjusted grade of 0.42 grams per ton, we still have high margin ounces. And, using $1,600 as our base case, the in situ value of the rock is $22 per ton. You net off the average mining cost in Nevada of about $11 a ton, and that still leaves you with 50% margin. So it's a lot of people don't understand. Well, Barrick and Newmont understand, and some of the other operators in Nevada understand. But you can still make a lot of money with sub 0.5 grams per ton material if the margin's there, and our low strip ratio protects that margin. So I'll quickly touch on some of the achievements and catalysts. Obviously, we're still a fairly new company. We went public in 2021. 2022, we drilled both Mountain View and Wildcat. We raised $16 million in one of the most challenging markets we've seen in many years. We submitted that exploration plan of operations at Wildcat. This year, we're off to a hot start, and again, like I was telling Anthony, some of these press releases aren't those sexy drill results, but we are showing people and doing what we said we were going to do. And so you look back on what we said for H1 2023, we're starting to let those, metallurgical results trickle out. You saw that with the bottle rolls from Mountain View last week. We just submitted the exploration plan. So what's to come this half of the year is going to be the rest of the met results for both Wildcat and Mountain View, and then obviously the updated resource and PEA, which we should have out by the middle of the year. And that will answer those 4 show-stopping risks. And then towards the end of the year, we'd like to go back and drill at Wildcat, which we think shows the most immediate resource upside. And then again, there's some more non-sexy work that's going to go into the mining plan of operations via engineering studies and environmental work. But once you get that mining plan of operations, that's what gives you a huge re-rating, in the sense that those ounces are worth a lot more than the ounces we have now, because you could essentially put them into production. And so that's what we're working for. That's why our focus is Mountain View and Wildcat. And that's what you'll see us do over the remainder of this year. So back to just the investment highlights, which I'll touch on quickly. You guys know them, and then we'll leave 10-15 minutes at the end for some questions. But why we think you should care about Millennial is we've got the right team. We've done this before. We've got in-house technical expertise. We've got expertise on operations, resources, capital markets. So we think we've got one of the best teams in the industry. We are in one of the best jurisdictions in the industry. The number one reason mines don't go into production is more often than not geopolitical risk, not economics. And so we're in the right part of the world. We've got a high quality assets, as I said. When you look at strip adjusted grade, we're at the top of the pack, and we're going to show you that we can grow the resource significantly in the next year. We're supported by some of the best long-term investors in the junior gold space. Plus, as management, we're aligned with you guys, right? We own a significant amount of stock, and we want to make money with you. And last, we believe we're undervalued, especially given those key catalysts we're going to hit by the end of the year, where we expect to see a re-rating, and you'll see re-rating off the PEA, re-rating off resource growth, re-rating off of a production permit, and then ultimately what we're trying to do is build, $1 billion production company so we can really all make money. That's all I've got from a presentation perspective, and maybe I'll flip it back to you, Anthony, if we want to go through any questions.
No, absolutely. Thank you for that, Jason. We feel that the company is well positioned to become, in our opinion, down the road, a multi-million ounce producer. Obviously, 2023 we think will be a big year for the company. A lot of news on being announced, and the PEA coming in the first half of 2023. So there's an opportunity to look at this stock below where management is invested, below where a lot of these institutions are invested, and so it's really worth a look. And then obviously with everything that's happening with gold at over 1,900 an ounce, and the positive outlook for gold. I mean, I've seen some really robust outlooks where they're talking about 3,000 an ounce, but for the most part I've seen that the consensus outlook is that we're going to be right around 2,000 and slightly higher than that. So it's a really good opportunity to take a look at gold right now after it's been beaten up for the last year or so. So at this point, I want to open the floor up to questions from our attendees. If you have a question, type it into the Q&A or chat box, or click the raise your hand icon, and I can certainly unmute your microphone. We've had this question before. Are you an American company listed in Toronto or a Canadian company operating in Nevada?
We are technically a British Columbia registered, so we're a Canadian company and we're operating in the US.
Okay.
Most of our management team is either Canadian or at one point was based in, we've got people kind of all over the place, but I'm based in Toronto, or VPX is in Montreal. So we are a Canadian company, and all of our mineral interests and where we plan to build a mining company is in Nevada.
Great. So is this going to be open pit versus underground, and talk about the different, talk about the CapEx versus what we would normally see from like a major underground mining endeavor?
Yeah, it's hard to compare it apples to apples, but generally for open pit heap leach projects, which is what we have, you're looking at a lot lower CapEx, right? It's more simple processing. You don't have to build shafts, and your mining costs are a lot lower, and your upfront CapEx is a lot lower, but generally your grade is also lower. And so, to make a huge underground project work, you need to have the grade to maintain that margin, right? And so that's why, if you look at even Talisker today, right? Like they're looking at an underground mining project, and so they've got grades of 6, 7, 8 grams per ton. Look at Osisko, right? And that justifies that higher CapEx, but it's a totally different risk, right? You're narrow vein mining. It's a lot more challenging to process, more CapEx. So what we're doing, and why people love heap leach projects, is technically they're very simple, right? You're digging up a bunch of dirt and ore. You put it on a pad and you sprinkle cyanide onto it, and you essentially, that's it, right? That's your mining process. And so, that's how we're able to make the grades that we have work and work economically. And so it's hard to compare, but I would say, blanket response would be heap leach is going to be lower CapEx, definitely lower risk, and a much more simple from both a mining and processing perspective, which is, by design, why we're in Nevada and why we think that with the team now, we can, we're very confident we can continue to explore, permit, and produce ounces from our assets, right? You don't need, it's very, very straightforward. And, case in point, you look at what Orla has done, right? They're $1 billion company. And they're producing, I think, 150,000 ounces a year, but it's heap leach in good jurisdiction, and it's a very simple, low capex, low cost operation. That's what people want in this day and age.
Absolutely, and I think it's substantially lower in cost, and I think that's going to make a big difference in the long term prospects of the company. So if you go back to that M&A slide, can you give an example of how far along was Railroad in terms of drilling and their valuation compared to where you are now?
Yeah, sure. And that's always that's a good one. And Railroad was just bought by Orla for $230 million. If you look at their mine plan, which was in there, I believe it was a feasibility study, right? So we're pre-economic study, then you've got your PEA, your PFS, and your FS. So they had done a lot more work for MET, they basically advanced the project almost to the point where you could make a production decision on it. And so that's why you see them trade at a much higher multiple. And it wasn't even that much higher, but it's about the similar size project. I think they had about 1.3 million ounces in their mine plan. We're at 1.2, going to 1.4, 1.5 in the near term, with significant upside beyond that. But one thing is that they don't have, or at the time of acquisition, they did not have a permit to produce. So that's still a ways away. And so once you get that permit, that's what gets you the $90, $100 an ounce. Because I believe Orla only got paid, I don't know, I think it was $60 an ounce. So it was a bit less, but they had done they've done a lot of work. That deposit has been explored, drilled, and studied for 10 years. And so, we like to look at ourselves as an early stage GSV because you get the same size mine plan with blue sky and upside, and that's only on Mountain View and Wildcat. You get the rest of the portfolio and Red Canyon for free, and we're going to show, that advancement towards a mining decision, with the first step being the PEA that we're going to show this year, which will show baseline economics and which will allow us to start working towards the mining plan of operation. So, it's what our CEO always says, and I think is a great point, is not all ounces are created equal. Premiums get paid for permitted oxide ounces. Permits give you a line of sight towards production, and oxide ounces, as we just discussed, are low cost, low capex, low risk. Not it's still risky business, but it's a lot lower risk than trying to put a narrow vein, high grade underground mine into production. Totally different story.
Yeah, absolutely. You have a question. Projected date for bottle roll info for Wildcat.
So we're hoping to get it back at some point next month. Again, unfortunately, a lot of this stuff falls outside of our control. All the materials been collected from all the drilling. The bottle rolls are underway. I know the columns are underway. So it's as soon as we get the assay results, we give them out to the market. We provide them to the market. I'm assuming we'll have it in the next month and a half. And that's a big one. And so far we like what we're seeing. Everything, we had the benefit at Wildcat is there was some historic network done. So we kind of know what it's going to be. And that's all outlined in the tech studies that are published on CDAR. For Mountain View, there was very little work done. So the fact that we get or that we see initial results coming back 85 to 90% in the oxide was just a huge sigh of relief, because this, like, we say heap leach is lower risk, but it's still a high risk business, and that's what creates the opportunity for high returns. But again, all the labs are backed up. We're kind of at the mercy of them for timing, but I'm fairly certain we'll have everything from a bottle roll perspective from Wildcat in the next month or so.
Yeah, and to get back to the point you made earlier, Jason has only talked about really focused on 2 properties. Really, he touched a little bit on Red Canyon, but it's mostly Mountain View and Wildcat. There's 5 other properties in the portfolio on top of that, so that are still, I think, show, have a lot of potential. So
Yeah, and, we'll get creative with that, right? I mean, I think we see line of sight towards producing gold from Mountain View and Wildcat the soonest. Next in line would be Red Canyon from an exploration perspective. We really like Outllok, but there's still a lot of work to be done. We're doing work in the background, but maybe we get creative and do some sort of JV structure with the exploration portfolio while we focus on putting Mountain View and Wildcat into production. I'm not sure. All I know is that, why you invest, or what attracted me to the whole mining sector or resource sector is just the optionality of it, right?
Mm-hmm.
With one drill hole, you can change the story. And so, I think you've got that optionality across Red Canyon, Cerro Colorado, Dune, Eden, Outllok, and Mar. And, all that we talk about as far as relative valuation, what we think we can get from a resource, total EV per ounce, that's all just Mountain View and Wildcat. You get the rest of the portfolio for free, but that's your option value, right? That's what takes you from 2 to 3x to 10.
Yep.
So that's what always is what I've always loved about the sector, and I think that's by design how we've set up the company. So you get, when you buy a share, you get development and exploration, and then you've got the blue sky sort of optionality as well, which can give you those really substantial returns.
Absolutely.